Blackmore shares among them. Top gainers there on the 200 in today's trade off the back of strong full-year results, with net profit surging some 90% on a year ago, with revenue inching higher and a final dividend of 42 cents a share. It's China segment, the lead driver, with strong sales momentum at the start of financial year 22. A different story though for its Australian business, with revenue down, with that weakness expected to continue, warning that challenges will persist as those border closures and lockdowns impact sales and foot traffic. And the Chief Executive, Alastair Symington, still pleased with the results despite those challenges.
The thing we're most proud of is all the disruption that we've all been facing over the last 12 months, whether it's here in Australia or in the 12 other markets that we serve across Asia Pacific. The fact that we can deliver top line sales growth of +3% and profit growth of +60% when we look at underlying net profit after tax is a terrific result. And that's despite the fact that we have seen a fair share of challenges here in Australia in the marketplace, and with the borders closed and with international students and travellers not coming to this market, it has impacted sales. But we've been able to pick it up in some of our fast-growing markets, in particular in Southeast Asia and China, which international markets is up 27% and China's up 28%.
And to Woolworths, it will launch a $2 billion off-market share buyback after lockdown sparked demand for its household items. Net profits spiking some 80% on more than $55 billion in revenue across the 12 months to June. And Endeavour Group has posted its first full-year results as a listed company, with retail sales up almost 10% and a net profit in the region of $450 million. Chief Executive Steve Donohue saying restrictions led to a strong lift in retail demand by liquor chains Dan Murphy's and BWS, and the group declaring a 7-cent a share dividend.
Numbers are good. We've seen a lot of favour come back into play with that sort of, with the current lockdowns going on. So it has helped out their business in the short term, especially with all of that pantry stocking that occurred in the first lockdowns that we had. Coles is getting back up to those all-time highs again. Pretty strong divvy in terms of what you're looking to get. We do like the Endeavour Group as a split off, so that's going to take away a little bit of some of the profit and upside there. Seems to be performing quite well on its own on the market now. So we definitely like that side of the business. And again, it's one of those ones that's been a beneficiary of this lockdown rather than more so being hurt by it.
And take a look at Endeavour shares today, off just over 2%. Now, of course, it has been a very trying year for the travel names. Taking a closer look at the sector, Qantas, full year net loss there, narrowing on a year earlier, coming in at just over $1.7 billion, with the company forecasting the pandemic to cost some $20 billion in revenue by the end of the year. Stripping out one-off items, earnings came in at $410 million, near the bottom end of the company guidance, but in line with analyst expectations. And looking ahead, the airline is planning to restart international services from the end of this year, with flying in the first half of next year to be around 15% of pre-COVID capacity. Analysts, though, not as bullish when it comes to Mr. Joyce's outlook for international travel to resume come December this year. And when it comes to the detail, Kyle McIntyre from Firetrail saying it wasn't about the headline number for Qantas, but rather the liquidity.
Even in an extended period of lockdowns over the next few months, Qantas has the balance sheet strength to be able to get through that. And of course, FY21 has been a really challenging period for Qantas, but really the Qantas investment thesis is all about looking forward and looking at Qantas post-COVID, post-vaccination rollouts coming through. And what we've seen globally is really strong demand for travel as things start to open back up. You mentioned the Flight Centre result before. A lot of the strength in that result has been driven by the US business starting to open back up and strong demand in the US business, including winning new accounts. And we expect to see that rolling out in places like Australia and the like.
And staying in the travel sector, Flight Centre reporting a $507 million loss for the year in line with guidance hit by the loss of JobKeeper. A brighter forecast, though, with Chief Executive Graham Turner saying the company continues to target a return to profitability for the leisure and corporate travel in fiscal year 22. And we can see there shares benefiting from that outlook, up more than 4.5%. Air New Zealand also reporting today, it's off close to 2.5%. Qantas receiving a good bump too, just as far as its outlook is concerned. Now elsewhere, City Chic shares touching a record peak after full-year profit more than doubled, boosted by online sales and a rise in its customer base, and with 44% of sales coming from outside of Australia. Chief Executive Paul Ryan told ausbiz the saving grace for the company has been its global presence.
You know, if we're an Australian-based store retailer, it would be very, very tough. Since we spoke, we've lost 33% of our trading days in the Southern Hemisphere stores, and that's leading to costing us around $1 million of profit line a month. But to offset that, our American business is flying. The US is really strong at the moment. I said into the market today that it's above pre-pandemic levels and that we are seeing a really strong response to opening up our whole product assortment to our customer in the US. The EU, with our Evans acquisition, is also back to where it was prior to the pandemic, which I'm very happy with. We've managed to get some of our assortment to her, but not all of it. And Navabi in Europe has been strong. But all that's been driven with Australia. Our online business has continued to do very, very well here too.
And a bit of a wild ride for retail food group shares, spiking out of the gates before giving up those gains after it swung to a net profit for the first time since 2017, currently up close to 4%. Same-store sales growing marginally, with its Gloria Jeans arm proving to the main driver.
Of 800 plus stores out there, probably half of them have been impacted significantly by COVID, being shopping centre based coffee shop kind of stores that rely on seated patronage, particularly in metropolitan and transport hub areas. The other half of the network, the Brumby's Bakery network, the Crust and Pizza Capers pizza businesses, and the Gloria Jeans drive-thrus, which have all substantially benefited from what COVID's delivered to us.
And a special dividend for IOOF shareholders, despite reporting a full-year loss for 21, weighed by a nearly $200 million goodwill write-down and acquisition and integration costs associated with its takeover of MLC that was previously flagged to the market. Company Chief Executive Renato Mota weighing in on the challenging environment facing financial advisors, saying there's a dislocation in the market at the moment.
Really challenging environment at the moment with financial advice, because you're right that there is a reduction in the number of financial advisors in the industry, and at the same time we've never seen a high level of demand for financial advice. So there's a dislocation in the market at the moment that's occurring. That being said, we see tremendous opportunity there.
And be sure to join us later when we speak to Jumbo Interactive Chief Executive and founder Mike Veverka off the back of its full year results. That's from around 4 o'clock Eastern here on ausbiz. Let's check out some of the other big movers today. And Appen and Link shares both took a hit after reporting underwhelming results. As you can see, Appen down over 21%. A2 Milk on track for its worst day in 3 months. Clearly those China woes lingering for the company as far as its outlook is concerned. And Whitehaven Coal shares higher, that's despite a loss for the full year on lower sales and impairments after downtime at its Narrabri mine. Weak economic activity earlier in the year also weighing on coal prices, though the company is expecting a stronger performance in the coming quarters as COVID curbs are eased. All right, let's just check what's on the docket tomorrow as far as earnings are concerned. And from 10 a.m, we'll hear from Dr. Mike Perry, Avita Medical Chief Executive. David Bailey will join us around 11:30, AFG Chief Executive. And later in the afternoon, Craig Scroggie, Next DC. He'll talk to us at about 1:30, followed by Bega Cheese Executive Chairman Barry Irvin. And we'll round that out with Rob Scott, Managing Director at Wesfarmers. That's from 3:30 Eastern here on AusBiz.